Okay, quick look at what's happening in North America as we kick off the new trading session. After some of the worries that we saw in the market yesterday about at what point we'll see, in the U.S. at the very least, a shift in interest rates. Right now we're looking at the S&P in positive territory. Same story for the NASDAQ, even the TSX inching higher. Skyler Weinand is the Chief Investment Officer at Regan Capital and joins us now with his perspective on the markets. Skyler, first of all, would you describe us as being in a bull market right now?
Oh, for sure. I mean, look at the S&P PE. We're at all-time highs back above 2 years ago. But when you look at that PE, it's a little bit lower than where we were a couple of years ago. You look at NVIDIA, though, the top seven. NVIDIA is up almost 40% this year. Incredible trading volume yesterday, 68 million shares traded yesterday at almost $700 a share. So I think folks are very comfortable in those top seven, and there's a tremendous amount of growth of consumer assets over the last 4 years since COVID. So you're talking about $39 trillion in growth between home equity, stock market, personal wealth. There's still a lot of money to go to put into the market. And so, yeah, we're in a bull market. There's a lot more that we could see over the course of this year, but higher interest rates might stand in the way of further growth of maybe another 5% this year.
I want to talk about that, but first, it's interesting to hear your comments about the momentum for big tech, because I literally had a guest earlier this hour that saw that as a problem for the market, that in his opinion, there's too much concentration in one area, and that isn't necessarily a good look for the markets. But it sounds like you're saying something different. You need to discount the fact that you've got, one or two or three companies. Mind you, they are big and they have a lot of influence, having outsized returns.
I think it's a tale of two worlds. It's hard to bet against a Google or a Microsoft or an Amazon that they're going to continue to be market leaders. They're going to continue to add market share and eyeballs. On the other hand, when you look at NVIDIA with its 40% run up in 35 days thus far this year, it's going to take a while for that revenue, that both top line and bottom line revenue, to actually flow through to the company. NVIDIA is not the same as a Google or a Microsoft that are charging huge subscription fees, getting gigantic ad revenue on a monthly and yearly basis. NVIDIA is hey, it's going to take 3 to 4 years for this to really play out. This AI revolution has to really ingrain itself in the economy. I'm not positive that actually happens.
Okay. All right. So that's the tech conversation. But getting back to what you were saying about interest rate policy for this year, what is it you're going to watch closely, just in terms of what happens in the market and obviously what happens with rates themselves?
I think the big thing that's not being talked about is demand, both supply and demand of bonds, U.S. Treasuries in general. Is the demand going to be there? We're still trading at a negative term premium, meaning 10 years are effectively trading below 2s. They've been there for a very, very long time, which spells a recession. But I think a lot of that has to do with demand. When interest rates hit 5%, there was a bell that went off at insurance companies, pension plans. Hey, we can fully fund ourselves by just going out and buying U.S. Treasuries, okay? But foreign buyers, China, Japan, Europe, Asia, I'm not sure they're going to show up when the U.S. has to print another $1.5 trillion a year to fund deficits, let alone add up U.S. national debt, 35 trillion, multiply that times 5% interest rates. You're talking about $1.5 trillion a year just in interest rate charges. So the jury's still out on, are the buyers going to show up to buy this debt that the U.S. Treasury has to issue this year? I don't think so.
And obviously
that's one part of the equation. That's the long end.
Yeah.
Now, the short end, bills, money markets out to about 2 years, the market hasn't been listening to the Fed for the last 2 years. They still aren't listening. There's so many triggers, there's so much bias towards, hey, rates are going back to zero, that have caused rates to come down. We've seen that just in the last 10, 15 days or so, where rates have whipsawed roughly 30 basis points. But the market's not listening. That the Fed has to keep rates high for a while, if not a long time, for inflation to really be kicked to the curb. And inflation is the number one thing on Jay Powell's mind, which affects all of consumers, not just leveraged players.
Skyler, we only have about 30 seconds left, but what does your gut tell you then, given what you've said about what happens with interest rates in the U.S. this year?
I think we're much more likely to go towards 5% rates again, if not higher, than we are back towards 3-handle rates. 1. 2, I think we're just as likely to see a potential Fed rise in interest rates versus a cut. So folks talking about May, June, September, when is the Fed going to cut? How much? Why? Everything's pointing to the Fed potentially starting to rise or hike interest rates in the next 3 to 4 meetings. So 2 major things: the Fed might hike and rates are going back to 5%.